Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited you're joining me here today. We do the show live every Tuesday to help you learn the ins and outs of passive investing so you can go into your next deal with confidence. So if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. There you will get access to our free ebook about passive investing, a checklist on what you need to know to get into your first or next deal. And you can get access to my calendar. We can talk all things passive investing. Not only that, you get priority access to our open deals here at passiveinvesting.com. So make sure to check out passiveinvestingwithwhitney.com. Now, today we're actually going to talk about note funds versus bonds. Okay, so what are the nuances between the two? Because I think investors sometimes use notes and replace the bonds, or investors invest in bonds thinking they're actually a combination of notes. Well, let's talk about what the similarities are, what the differences are, and just like what you need to know, be aware of to figure out which of these positions should or could be in your portfolio. Now, if you don't know me, again, welcome. My name is Whitney Elkins-Hutten. I'm the Director of Investor Relations here at passiveinvesting.com. And this is me and my crazy crew. This is the whole reason why I invest in real estate, is so I can have the freedom and choice on how I spend my time. And, my husband, daughter, and I, along with our dog there, Kona, we spend a lot of time traveling and spending time together as a family, seeing new places. And that's all possible by how we've chosen to scale our portfolio. Now, I started off living, flipping, and house hacking, and then eventually had a very active single family rental portfolio. And then I was like, man, I've got another job. That was what I was trying to replace, the income from my job. And I've just created another one for myself. And so really, it was when I learned how to scale into the passive side of real estate, into private equity deals, that the acceleration growth on my portfolio really took off. Now here, before you guys quote me, ask me the question, I still do actively invest in real estate. My husband and I, we do have controlled investments that we still manage on our own. So that is a part of our portfolio, but it's really that ability to scale in partnership over 6,500 residential units, 2,200 self-storage, and those 15 express car washes. It's the result of having a portfolio of that size that's given us. And that's 100% control and freedom on how we spend our time. And we can help you do that here at passiveinvesting.com. We have over $290 million deployed in our rehab wallet loans, our debt fund, and we're going to talk not specifically about the debt fund, but we're going to compare and contrast on, what does investing in a vehicle like that do for you and your goals. But we also have our equity portfolio, 1.4 billion assets under value, and strong exits for our investors. Now today, just a quick disclaimer, anything that we go over here today, it's not financial advice, legal advice, or tax advice. So make sure that you're taking this advice back to your investment team before making any investment decision. All right, I always like starting off with okay, what are we actually talking about? Let's define this for ourselves. And that is, what is a note fund? Okay. And then what is a bond? A note fund is really an investment vehicle that primarily invests in debt securities backed by real estates known as notes. So in the case of our real estate debt fund here at passiveinvesting.com, there's a pool of over 1,300 loans in that fund. And that when an investor invests into the fund, their investment is securitized by all the notes that are currently deployed in that fund. Now, note funds are typically managed by professional portfolio managers or investment firms, and the whole point of the fund is to usually generate a stable return for our investors through what we call interest payments. Now, some funds do give some sort of equity with potential capital appreciation. Those tend to be a little bit higher risk funds, but you could find that as well. Okay. Now let's pivot. Now that we understand what an actual note fund is, a pool of investments such as notes. In the case of, the example of our fund, about 1,300 notes that securitize all of the investors' investments into the fund. And the whole point of the fund is to generate income. Well, then what is a bond? Okay, a bond is also a debt instrument where the investor loans money to an entity, typically a corporation or a government, for a defined period of time at a predefined interest rate. Essentially, what you're doing is you're securing what we call an IOU for that investment. Okay. Now, those IOUs are issued by the borrower, promising to repay the loan, the principal or the face value, at a future date, known as the maturity date, along with periodic interest payments or coupon payments made at regular intervals until maturity. So on the surface, note funds and bonds kind of seem like the same thing. However, a note fund has securitized investments in it. A bond is essentially an IOU. Okay, so how else do they compare? Well, past that, the comparisons are pretty slim. Similarities, I should say. So both can generate, stabilized income for the person who's investing in it. But there's some very distinct differences that the investor should be aware of before they invest. That is, how are they structured? What kind of diversification do they offer? Are they liquid? What's the risk and return profile? And then how transparent is that instrument that you're investing in to you? So let's take each one of these differences and kind of dig a little bit deeper here. So note funds, in this case, as far as structure, investors buy shares or units of the fund, which represent a proportional ownership interest in the portfolio of notes held by the fund. Okay. You can plainly see the securitized, what's in that fund, what's securitizing the fund, and the investor is investing in those shares. Now, a bond, investors are purchasing a specific debt instrument issued by a company or government, and that is specifically an IOU. Okay, so the structure may or may not be as transparent to the investor. Diversification. Note funds, investors are typically diversified along a broad range of debt securities. The fund manager selects and manages the portfolio notes, aiming to optimize risk and return for investors. Now, on the publicly traded bond side, investor investment is concentrated in that particular bond issuer and its associated credit risk. So if you're investing in a bond, backed by the United States or by like a corporation, you're pretty concentrated into that particular area. So note funds tend to give you greater diversification. Bonds, publicly traded bonds, tend to give you more concentration. And so it really depends between the two. Like, do you want to be concentrated or do you want to be more diversified? Now let's talk about liquidity here, okay? Note funds generally offer liquidity to investors. Okay, sometimes they have short lockup periods for a larger return. In the case of our note fund, we're looking at, for investments under $500,000, there are no lockups. Like, you can, as soon as your funds are invested, you could, let us know that you're redeeming the very next day. We've got 90 days to return your money to you. They're very liquid instruments. Publicly traded bonds, however, may have less liquidity, especially for bonds issued by smaller companies or in less liquid markets. Okay, and then so whenever you're looking at the bond market, you might have a 3-year bond, 5-year bond, 7-year bond, 10-year bond, right? That tells you how liquid you are in that bond, and that liquidity will also impact your return profile. Which leads us to the next question. What is another difference here is the risk and return profile. So note funds carry varying degrees of risk depending on the types of notes that are held in the portfolio. So for example, you could invest in a note fund that invests in all second liens on properties, meaning they're investing in the debt that sits behind the senior debt, like a home equity line, not home equity line of credit, but home equity loans, that type of thing. Okay. So that's a riskier position than if you invested in a fund that held the primary debt on the property, like in the case of our fix and flip fund. Okay. The latter, our fix and flip fund, would actually offer less risk to the investor. As far as risk return profile, well, before I move on to publicly traded bonds, note funds, typically when the further away from down the capital stack you're at, the higher the return should be to you. Okay. Another thing that we see in the space is that, note funds right now, a lot of operators are leveraging their funds, okay, taking out, aggregating investor monies, going to the bank, taking out, using those monies to secure a larger line of credit or a larger loan, and then they invest all the monies together. That can also, while it can juice returns, it can add additional risk to the portfolio. All right. Now, publicly traded bonds, okay, they carry risk depending on the credit quality of the issuer and other factors. But investors have more control over the specific bond they purchase. So while you're getting certain concentration in an area, in a publicly traded bond, you pretty much know that is your risk, and so you can evaluate it. Like, you don't have like a whole pool of risk to look at. So, but you've got to balance all that together between the diversification and your risk exposure and the return that you want to get. All right, now let's talk about transparency. Note funds, they're required to provide regular disclosures and reporting to investors, including information about the fund's holdings, performance, and fees. This transparency helps investors make informed decisions about their investments. Publicly traded bonds offer transparency, but the investor will need to research and analyze the individual bond issuer to assess the credit risk and other factors. Okay, so kind of what does this mean? It sounds like they're kind of the similar thing, and they're, both cases you can get a lot of transparency. In both cases, you cannot have transparency. But, with a note fund, that operator should be able to tell you exactly what their underwriting procedure is for every single one of the borrowers of the loans in those funds. In a publicly traded bond, it's up to the investor to research and analyze the bond issuer, right? Because there's essentially no middleman managing that, right? Like, the company or the government issues the bond, the investor either buys the bond or not. The investor's on the hook. They don't have any third party in there doing credit checks or anything like that. So really, at the end of the day, which wins? Note funds or bonds? Well, here's the thing. It's a choice, okay? As everything goes, it really depends. So let's kind of run down some things here that a decision-making framework. One, both note funds and bonds offer that fixed income security. Okay, so the whole point of investing in either one is to get that regular income. Note funds are a convenient way for investors to access a diversified portfolio of debt securities through one investment, okay? And ideally achieve an asymmetric return. You're getting diversified across various borrowers, depending on the fund, various borrowers, markets, and deals. It can also create velocity of the term, meaning you can continue to take in some funds, in the case of our fund, you can continue to take your distribution and invest it back into the fund and create compounding with it, okay? You can also have some liquidity with it as well. So you can, maybe, use it for short-term type of instrument where you need to, access cash in, say, like 90 to 180 days. That's a great place to put, cash as well. Or you can continue to reinvest for that compounded growth. And when we talk about the velocity of the turn, the notes in the note fund, you want to understand, when do those notes come due, right? Because when the notes come due means that's kind of the lag time that the note fund gets to adjust to the interest rate environment. So in the case of our note fund, we're adjusting every 6 to 9 months. And not all notes come due at once, so we're constantly making that adjustment as the fund moves forward. In a publicly traded bond, the key thing here is the investor has direct ownership of an individual debt instrument in a company or government, okay? However, people should be really aware that when interest rates rise, bonds typically fall. That's typically how they respond. So notes generally the opposite, right? Because there's a flight, bank money will essentially like kind of dry up, and note funds, especially in real estate, can step in and fill in the gap. All right, guys, I hope that information really helped, give some clarity around what is a note fund, what is a bond fund, what are the key differences between the two, what are the similarities between the two, and how can you like kind of go through each of those differences to understand how these type of instruments can help you meet your investing goals. If you guys want to learn more about, how to secure your financial foundation, how to grow and protect your wealth, you can check out my new book, Money for Tomorrow, How to Build and Protect Generational Wealth. It's available on Bigger Pockets at biggerpockets.com, Money for Tomorrow. You can also find it on Amazon. And this is also your invitation to action. If you want to get access to future masterclasses like these and continue to stack and build your knowledge and feel more confident about your first or next investment, join me at passiveinvestingwithwhitney.com. And these are all the goodies that you get there.